Cash is king, but right behind it is the conventional loan. About 70% of finance loans are conventional, so it behooves you to know the ins and outs of the program. But that's why you're here. In today's episode, we're going to talk about the new 2024 loan limits, credit requirements. When do you put down 3%? When do you put down 5%? A huge update for house hackers, down payment requirements, also a very creative way that you probably never thought of. It also will help you not sell grandma's house, as the folks like to say, debt to income ratio, the appraisal, and much more. If this is your first time hearing the sound of my voice, my name is David. I have a background as a mortgage lender, a background as an underwriter, and as a realtor. I purchased multiple homes myself, but most importantly, I've helped hundreds of people like you buy their first home in real life. I don't just talk about it on the internet. Let's go get those keys. Welcome back to House Rich, the first time homebuyer show where we provide you actionable steps in layman terms to buy your first home. Let's start with a little bit of background because you probably heard the terms conforming, conventional, Fannie Mae, Freddie Mac, and they're sometimes used interchangeably. Fannie Mae, the Federal National Mortgage Association. If you say FNMA real quick, it kind of sounds like Fannie Mae. They were established in 1938 to provide some stability to a chaotic housing market and really economy after the Great Depression. Their role is to purchase loans on the secondary market because, believe it or not, your lender does not have the money to make all the loans they make you. And think about it, you get a loan for $300,000. What happens at closing is your lender pays the seller $300,000 and you pay $300,000 plus interest back to the lender over the course of 30 years. So they're always kind of behind on collecting the money. So they package loans together into mortgage backed securities and they sell them to Fannie Mae's and Freddie Mac's of the world. Who's Freddie Mac? Well, Freddie Mac was established later in the 1970s in order to provide some competition to Fannie Mae so they wouldn't have a monopoly. Speaking of monopoly, those two GSEs or government sponsored enterprises, they have 90% of the market, so they have a huge sway when it comes to guidelines and what your lender does. As a result, they pretty much set the standards. So everything I point out to you in today's episode will be the minimum guidelines and standards from Fannie Mae or Freddie Mac, but lenders can put things on top of those, which are called lender overlays for conventional or slash conforming loans. Those two words are pretty much used interchangeably. Now that we got a little bit of history behind us, let's talk about when do you put down 3% and when do you put down 5%. Well, it's important to note that for a conventional loan, a first-time home buyer is defined as somebody that has not had their name on the deed to a property in the last 3 years. That's whether you've lived in the property or not. So, if you're a first-time home buyer, you could put down 3%. Or if you're not a first-time home buyer, but you're using either a home ready or home possible loan, those are kind of spin-offs from the Fannie Mae and Freddie Mac's version of a lower down payment conventional loan. You can put down 3% as well. And to be clear, these are for primary residents only. If you're not a first-time home buyer, you have to put down 5%. Or if you are a first-time home buyer, but you're buying in a high balance loan area, you unfortunately have to put down 5% as well. We'll get into the high balance loan areas in a bit when we talk about the updated 2024 loan limits. Now here's a huge update. As of November 18th of 2023, if you're planning to live in a multi-family property that's 2, 3, or 4 units, the minimum down payment has been lowered to 5%. It used to be all the way up to 25% for a conventional loan. So to the point that it didn't even make any sense to use a conventional loan on a multi-family property. Later in the episode, we'll get into how the income is considered for conventional loans because it is different for an FHA loan when we talk about rental income. Now, if you're looking at a vacation property is defined as a property you do not live in as your primary and also nobody else lives in. That is 10% down. And for an investment property, that is at least 15% down. An investment property is defined as a property that somebody else lives in. That has nothing to do with collecting rent. So, for instance, if you have another property and like your cousin lives in it for free, that is still considered an investment property per conventional guidelines. What if you're like, man, I don't have the money for the down payment. Is there any way that somebody can help me out? Well, let's talk about seller concessions. Seller concessions are a percentage of the sales price that the seller can contribute to help you with the closing costs. These are the maximum allowable amounts. If you're putting down between 3 and 9.9%, the seller can contribute up to 3.5%. If you're putting down between 20 and 24.99%, the seller can help with a 6% concession. And if you're putting down 25% plus, the seller can help with a 9% concession. If you're buying an investment property, no matter what you put down, the maximum seller concession is 2%. Now, seller concessions are great for you, the buyer, but of course, the seller does not like them because that's less money in their pocket during the transaction. So, talk to your realtor about what may be preferable for your market when it comes to seller concessions. You can also get a gift to help with your down payment. I'm going to read this straight from the guidelines so there's no misinterpretation. A gift can be provided by a relative defined as the borrower's spouse, child, or dependent, or by any other individual who is related to the borrower by blood, marriage, adoption, or legal guardianship, or a non-relative that shares a familial relationship with the borrower defined as a domestic partner, or relative of the domestic partner, individual engaged to marry the borrower, former relative, or godparent. The donor may not have any affiliation with the builder, the developer, the real estate agent, or other interested parties in the transaction. Translation: if you are a family member, you can help somebody with the down payment because family can help family. They don't want anybody with direct ties to the property or that is directly compensated being able to help somebody with the down payment because it can lead to kind of shady arrangements where it's like, hey, this shadowy figure is for some reason giving this person $10,000 to $15,000 to help the down payment for the sale of the property. And they're doing it because there's some deal on the back end and they're just basically like a straw borrower. And this person owns the property in name because there's actually a maximum amount of conventional loans you can have. Here's another way to get the down payment for a property a lot of folks have never heard about. It's called a gift of equity. I'll give you an example. Let's say, grandma has a property and it's worth $200,000, but there's $50,000 left on the mortgage. And you're like, man, we don't want to sell grandma's house, but I don't really have the money to do anything with the home. I don't have the money to purchase the home. Well, how a gift of equity works is the starting point for a gift of equity is 80% of the home's value. So on grandma's $200,000 home, the starting point is $160,000. And so we have a mortgage that is $50,000. So grandma in this scenario can gift you up to $110,000 to cover the down payment on the property. Now, a realistic scenario here would be, let's say grandma sells you the home for $100,000. Now, in this scenario, she would gift you $20,000 to help with the down payment on the home. I picked $20,000 because that is a 20% down payment. That allows you to avoid mortgage insurance. We're going to ignore all closing costs and things like this to make the numbers easy. So how the math will break out there. Sales price, $100K, she gives you $20K. So now there's $80K left for her. After paying off the mortgage, she would get $30K. And then you have all the money you need from that gift of equity to help pay for your closing costs. So you essentially come out of pocket no money. Of course, there are closing costs and stuff like that. So you would finagle that number to whatever exact number covers your closing costs as well. But that's a quick way in order to get the down payment if you're keeping a family or keeping a property in the family. I have a much longer episode on this topic as well. I'll list it down in the description. Now, the moment you've all been waiting for, the updated 2024 maximum conventional loan limits. For a single family property, the limit is now $766,500. For a 4-unit property, the loan limit is $1,450,000. $474,400. As a point of reference, comparing this to the FHA loan limits, a 1-unit property there is $498,000 and change, and for a 4-unit property, the max limit is $958,000 and change. So much higher than the FHA loan limits. Now, there are high cost of living areas. You probably know if you're in a high cost of living area, and those loan limits are higher as well, because I'm a realtor in Dallas and would love to help you reach your goals of home ownership. So click the link in the description and just schedule a call no matter where you are on your journey. Not in Dallas? No worries, I can help connect you with a vetted realtor in your local jurisdiction as well. And feel free to share with friends, family, and foes. Everyone gets love. If you're like in LA, for instance, a house probably costs a lot more than it does in, let's say, Des Moines, Iowa, for example. So those maximum loan limits have been raised. And for a 1-unit property, the max loan limit is $1,149,825, all the way up to a 4-unit property, $2,211,660. Now you're thinking, like, how do I actually know if I'm in a high cost of living area? Just go to Google, type in FHFA, conforming loan limits plus map, and it'll be the first option. And so here are a couple examples from the map. If we go to my old stomping grounds, Prince George's County, let's see what we got here. The maximum loan limit is $1,149,825. But there are some areas that are in between. So for instance, if we go a little bit further up north to Massachusetts, Plymouth County, the loan limit is $862,500. So if you're not sure, definitely check out that map. But I'd like to point out, so there's no confusion, these are the loan limits, not the purchase prices. So let's say, for instance, the home is listed at $790,257.73, a very precise number, almost like I calculated that number for this example. And you put down 3%. Well, that will give you a loan amount of $766,550. So you'd be within the conforming or conventional loan limit. So once again, that's the loan limit, not the sales price. But what happens if you buy like a $800,000 home? After a 3% down payment, your loan would be $776,000. That is above the conforming loan limit. So what do? What happens above that threshold? Well, you move into what's called a jumbo loan. Those guidelines are much stricter. They're higher credit requirements and higher minimum down payment requirements. Typically going to need like a 680 or most likely a 700 credit score in order to get a jumbo loan, and your minimum down payment is typically 9.99%, and that's if you have like a 740 or 780 credit score, but you're looking at most likely like 10-15% down. So what do? Well, just put a little bit more down in order to get to the conventional loan limits. Now let's talk income. Your lender wants to see a 2-year job history in order to consider your income, with the one exception being you recently graduated college. In that scenario, you don't need any job history as long as you've secured a job and have an offer letter. Your lender will assume that your income continues in perpetuity. But here's where a lot of people get that guideline confused. That's just your base income. So for instance, things like overtime, commission, and things of that nature, your lender wants to see a 2-year history. If you don't have the 2-year history, the lender is not counting that income. So I'll give you this real life scenario for one of the first loans that I dealt with. A gentleman went from making like $80,000 was his base salary. Then he took on a sales role and his base salary went down to $40,000, but he made like $60,000 in commission. So he went from 80K W2 to 100K W2. However, unfortunately for him, he did not have a 2-year history of commission, so we only could count the $40,000 in base income in perpetuity. So unfortunately, he was not able to qualify. But there's some more intricacies to that non-base income. Here's an example. Let's say you got a bonus in 2021 of $10,000 and then in 2022 of $20,000. The lender is not using the 20,000. They'll take an average of those two and they'll consider 15K for your bonus as far as your projected income in perpetuity. Now, let's use that scenario backwards. Let's say you got $20,000 in 2021 and then $10,000 in 2022. They're not taking the average, they're taking the lower number. So now it's a $10,000 bonus in perpetuity as far as considering your income in the future. And if there's a scenario where, let's say you killed it with commission in 2021 and got like $80,000, but then something happened and you went down to, let's say, like $25,000, the lender may look at that and say, this is a pretty steep drop. Unless you got a very great explanation on what happened, we're actually not going to consider any of your income at all. So something to note when it comes to calculating income. Now let's talk about rental property income, because hey, we got these new guidelines as far as only 5% down for any multi-unit property. You can include income from ADUs or accessory dwelling units on 2 and 3 unit properties from some lenders, but you must already own a primary residence or otherwise have a current housing expense to qualify using rental income. Even still, rental income can only be applied up to the amount of the property's mortgage costs unless you have a year of documented property management experience. So I think a lot of people get confused is they're like, okay, with an FHA loan, I can use the projected income. But with a conventional loan, you need that documented history of property management experience in the first place, which you probably don't have as a first-time homebuyer. Now let's talk about for a single family property. You're thinking a single family property, hey, I can't have renters. Well, if you have somebody that's living with you in the property, this is what happens. With a home ready and home possible mortgage, you can use border income from a roommate who lives with you and will follow you to the next home. Fannie Mae's Home Ready program also allows you to apply ADU rental income on single unit primary residences. In contrast, Freddie Mac guidelines allow ADU income on all single unit primary loans. Now, if you're self-employed, please do not try to calculate your income yourself. You 100% need to talk to a lender. Because here's the thing, you're probably giving your tax returns to a CPA or something like that. Well, your CPA's goal is to write off everything under the sun, so you pay the least amount of taxes that you need to. That's great for you, but your lender is only using your taxable income. So make sure you consult with a lender, maybe even before you file your taxes if you're looking to buy a home in the future. And yes, there are scenarios like bank statement loans and stuff you can use as well, but you'll get killed on the interest rate. But hey, that may be an option for you if your CPA has already written off everything under the sun and you still want to qualify for a mortgage. Now, the minimum credit guideline for a conventional loan is a 620. Having said that, it's very hard to qualify for a conventional loan with anything less than a 640. I personally have never seen anybody qualify for a conventional loan with less than a 640 credit score via automated underwriting. I guess it could happen, but I've just not seen it. You're going to want to be at around 640 to 660 if you're looking at a conventional loan. And once again, if you don't qualify conventional, FHA may be an option for you as well. Now, if you're looking at like a 2-unit property, you're going to want to be at least a 640. And if you're looking at a 3 to 4 unit property, 660 is going to be your minimum credit score. Here's some other showstoppers in the credit world, no matter what your credit score is. If you had a foreclosure, you cannot get a conventional loan unless it's been more than 7 years ago. For a bankruptcy Chapter 7, a 4-year wait. Bankruptcy Chapter 13, 2 years wait. For a deed in lieu of foreclosure or a short sale, you're going to have a 4-year wait. And if you have any IRS debt, you're going to need to have a payment plan in place. And that's like with the IRS, not just, hey, I got this plan to pay Uncle Sam, $200 a month. And also that plan will be added to your debt to income ratio, FYI. Let's jump into rates, because are rates on conventional loans better or worse than FHA? Well, typically what happens is FHA rates are a little bit better, but the mortgage insurance is higher. And that's very important to note, because the mortgage insurance on a conventional loan drops off at the 80% loan to value ratio. if you actually reach out to the lender and ask them to drop it. If you don't say anything, the lender will not drop it until it reaches 78%. And that can be years, that can be many years for two reasons. At the 80% threshold, that can happen because you've either paid down the loan or it's appreciated. And usually it's a combination of the two. Like you pay down the loan and it appreciates. And so, depending on the market, you may be at that 80% loan to value ratio in like somewhere between 3 to 5 years. Waiting to hit 78% will take a bit of time. With an FHA loan, the mortgage insurance never drops off the loan. With the exception of you putting down 10%, it drops off at the 11-year mark. But let's be honest, you're not putting down 10% on an FHA loan. If you're debating between the two and you're like, this rate for a FHA loan is a little bit less, keep in the back of your mind that the only way to drop that mortgage insurance is to refinance into a conventional loan. And refinances, one, are not free. They're typically a couple $1,000s that you're going to have to add onto the principal balance of the loan, which also increases your payment a little bit as well. And also, there's actually no guarantee you can ever refinance. Like if we look at rates this year, 2023, rates have gone up like 3% over the course of the year. So if you got an FHA loan like in February when rates were like in the fours, like right now, interest rates are in like the 7% threshold. So you could be at the 80% threshold. Well, probably not in like 8 months, but you know what I'm saying? You could be at that 80% loan to value ratio threshold, but it makes no sense to drop the mortgage insurance because your rate will be going up 3%. So just some food for thought there, especially when you hear bozos say, hey, just marry the house and date the rate. Now, you may remember the controversy from earlier in the year where Joe Biden decided to raise interest rates on everybody that had good credit when applying for a loan. It was just an exercise in people showing like their political leanings and the fact that they cannot read either, because nobody actually ever reads anything. They just look at headlines and they run with them. So if you're on YouTube, here's a breakdown of the before and after changes based on the loan level price adjustments from the Biden administration. If you're watching, you would see that everybody putting down less than 5% on a loan, their interest rate got cheaper. Yeah, just to be quite frank, if you're putting down more than 5% and you had like, better credit like 680 and above, you did take a little bit of hit on what you're paying now versus what you would have paid before these changes. The loan level price adjustments were designed to help people that are putting down a lower down payment. But here's the thing, there's no scenario where somebody putting down had a 780 credit score and is putting down 20% will get a lower or worse rate than somebody that has a 640 credit score and is putting down 3%. That is not how this works at all. These are one of many loan level price adjustments. Some other loan level price adjustments are the loan size, the property type, the area you purchase the property in, and things like your down payment have a bigger impact on the interest rate than really anything. So yes, if you had putting down like 20%, your interest rate may be 0.125% higher than it was before the change, but it was already like a whole percent sometimes lower than somebody putting down, let's say 3% on the loan. So just have some perspective there as far as what the changes were. Here's the thing, the changes, all the changes, you can, I guess, wind if you want to, but they're already changed. So let's talk debt to income ratio. There's a front end and a back end. Your front end is basically your future mortgage payment divided by your income before taxes. Your back end is your future mortgage payment plus your monthly finance debts divided by your income before taxes. With a conventional loan, you can go all the way up to 49.99%. Having said that, once again, the bottom of the equation is your income before taxes. The income you have in your pocket is after taxes. I highly recommend not going up to 49.99% because your real life debt to income ratio can be as probably like 80, 90, or sometimes over 100%. That's why a lot of times you hear folks are like house poor. And these monthly finance debts are also just things that are financed. So we're talking like minimum credit card payments. We're talking like your car payment and things of that nature. We're not talking about like childcare. We're not talking about your weekend spending habits. So those are items that your lender is actually not factoring into your DTI as well. So that's how sometimes people's real life debt to income ratio is like over 100% after a home purchase. Here's a real life example of calculating your debt to income ratio. Let's say your projected future mortgage payment is $2,000. As a reminder, start with a monthly payment in mind and work your way back to the home price. If you need help on doing that, I will have an episode breaking that down in the description as well. But your future mortgage payment is $2,000, and your car payment plus your minimum credit card payments. Your car payment is like, let's say, $450, and your credit card payments minimums are $50 a month. The top half of the equation is $2,500. Let's say you have a W-2 job, you make $60,000 a year. 60,000 divided by 12, you make $5,000 a month. Like in that scenario, your debt to income ratio would be 50%. So you'd be slightly above the threshold, but you'd be kind of right in that ballpark. But that's a quick way on how to calculate your debt to income ratio yourself. As a reminder, if you are self-employed, have your lender do this for you because it's not for the faint at heart. Appraisals. Your conventional appraisal is a little bit more friendlier than an FHA appraisal. With an FHA appraisal, there are certain showstoppers like the life of the roof, loose wires, working heating, which is something that probably should be in all houses, but that is a deal breaker when it comes to an FHA loan. And things like handrails being on railings, things that are kind of like minor. The conventional loan does not require those things to be fixed in order to provide funding. Another pro of the conventional loan is sometimes you can do what's called a desktop appraisal. It is what it sounds like. A person sits at a desk, they look online, an appraiser, they look online, they look at comparable sales online, and they just calculate the value of the home based on that. Sometimes they'll also drive by the property just to make sure it's like still standing, and it kind of looks like the pictures online, but they will never go inside the property, and they'll assess the value of the property like that. That's great for you because you don't have to pay like the $500 appraisal fee in that scenario. It is much, much cheaper. Now here's the other, maybe a small con on this is, let's say the house is like just newly renovated, is very, very dolled up inside. Well, that appraiser may not have won't have access to those updates because they may be looking at old pictures of the property. So in that scenario, like the appraisal may come in a little bit low doing the desktop appraisal. Well, in that scenario, you can just ask for a full-fledged appraisal from your lender. Also, in some scenarios, if the sales price is well under like the market values in the area, you may be able to get an appraisal waiver altogether. And when it comes to seller perception, sellers greatly prefer a conventional loan over the FHA loan, also for something called the amendatory clause. So with an FHA loan and a government loan like VA as well, there's a clause that states if the appraised value of the property comes in at less than the agreed on contract price, the buyer can actually back out of the contract even after the option period and still get their earnest money back. This clause does not exist for conventional loans, which is another reason sellers like conventional loans more than FHA loans. And also there's kind of like this just perception that people that are using FHA loans just have bad credit and therefore are a little bit irresponsible. And so it's a little bit discriminatory, but a lot of times like sellers, realtors will steer their buyers away from FHA offers. So it's not right, but it's one reason I like to point out, if you qualify for both a conventional and FHA loan, a lot of times it make a little bit more sense to go with the conventional route. Also, did you know there's a conventional renovation loan? It's called the home style renovation loan. It allows you to roll the purchase price and the repairs into one loan. So you can do things like renovate the kitchen, bathroom, landscaping, add an ADU to the property, and also add a smaller property to the property. What you can't do is things like add like a bigger house to the land as well. But that's something you may want to look at too as well, is it gives you the option to buy the ugliest property on the block and turn it into your own gem. I think that's it. If you rocked me, let me know you made it to the end by dropping a house emoji down in the comments or leaving a review. But as always, buy land. Rumor has it they're not making any more of it.